everybody. Thanks for being here. You have the bios for everybody, so I won't spend a lot of time with that, but it's great to be with this group. It's a very diverse group in terms of some of the information you're going to hear, but it's all sort of tailored around markets and geopolitical risks. So again, thanks for joining. And I'm going to start with Scott way at the end, because you had a podcast yesterday, and the title of it was effectively, Expect a Volatile Bull Market. Speak to that, because I think a lot of people are expecting similar.
Well, I think the starting point is how we came into 2025. We ended the year at a fairly extended valuation for the S&P 500, for most of the equity markets in general. And we argue that that was a function of a couple of things: a lot of confidence in AI spending and related tailwinds, along with, let's call it, a soft landing sentiment that was permeating the broader market away from just the tech. We also knew that going into the year, we'd be looking at a Trump policy agenda that continues to play out. Now, we had expected that it would essentially be a first 100 days, maybe first quarter, maybe first half influence, but it looks like it's permeating, Guy. And so what we're looking at now is an ongoing volatility risk around Trump policies, but what we're trying to delineate is, yes, got it, we've got macro headlines, we've got Trump policy headlines, but under the surface, we expect that fundamental volatility will be a little bit less than that you would read and expect looking at just the headline action.
So much of this is predicated on U.S. China relations. So Sean, I'm going to go to you, because that's obviously front and center. There's some meetings taking place, I believe today, I know yesterday. So speak to your view of the state of U.S. China relations right now, the impact it's having on your business and on the markets.
Yeah, so at Tria Capital, we're a very China-focused bottom-up fund, right? So in terms of how the tariff, et cetera, play out, we don't have a crystal ball to really predict. But this year, our fund been doing 40% plus, really from a bottom-up perspective. I can talk about a couple of things that we're really focusing on from a bottom-up perspective. For example, Pinduoduo is one of the names we have in our portfolio. We pitched it in the Seoul conference. If you look at the valuation right now, right, despite all the headline news, et cetera, like PDD and the onshore valuation is around 9.7x PE. Like more than 35% of their market cap are in cash, right? So even for the domestic business alone, it's you get a tremendous value from a bottom-up perspective. But even on the Temu part, which is the overseas e-commerce business, even we did a lot of data analysis running from bottom-up, comparing versus Amazon, et cetera, looking at the tariff effects. So even after April, if you compare Temu prices versus Amazon haul prices, it's still 10 to 30% cheaper, right? And we did a lot of channel check, for example, with a lot of overseas e-commerce guys. We figured Temu, they really have their strong competitive edge coming from their really culture in between, and really from the team that able to work very well with a lot of these overseas e-commerce provider. And keep in mind, like for example, Amazon has more than 50% of their good coming from China anyways, right? So for us, it's really try to understand each of these companies, where the competitive edge is coming from. In the long run, are these sustainable? Is it a company that we think can you compound through time, right? So if you think about investing for us, if you compound something 12% for 10 years, that's 3x. If you do it for 100 years, that's 84,000x, right? So that's really where we're focusing on and try to look for different opportunity. I would say another thing that's within China is historically it's been manufacturing of the world, right? So if you look at the consumer value added curve, it's in the middle part, very low margin, manufacturing, exporting. But nowadays, if you look at a lot of Chinese companies, they've actually been pivoting to more of the first end, so more innovation, more R&D, and also to the later end, more brand building, more direct to consumer. So you see a lot of companies, for example, like Anta, that bought out Amor, that just got listed, that has like Wilson, has Arctech underneath it. You can see like Geely, have Volvo, have Lotus underneath it. So a lot of Chinese companies, not only they've been manufacturing quite well, they've been doing more innovation, they've been doing more brand acquisition, and also going overseas, executing quite well, where we see there's a lot more opportunity of that, right? So where we're trying to focusing on is finding, say, the Nike of the world, the Starbucks, the Apple, et cetera, that's in China, and eventually we think they have a global competitive edge that be able to expand overseas. So you see like TikTok, you see Shein, you see Temu that I just mentioned under Pinduoduo. There's more and more of these cases that's coming up.
We're going to go back to China in a second, but I'm going to go to South America now with you, Nicolas, because Argentina has been one of the either it's one of the great success stories of the 21st century or yet to be determined. But your background is pretty amazing. IMF, World Bank, Minister of Finance in Argentina. It is a great success story. So speak to what you're seeing there. And if I may, what do you think the next Argentina could be potentially in South America? It looks like Brazil is starting to emerge a little bit.
Yes, as you mentioned, a lot is going on in Argentina. You know, after 15 years in which a populist administration drove the government expenditure from 25% of the GDP to 42%, an effort to bring down that started with President Macri. Then the populists regained power in 2019, and now Milei came in 2023 with these very strong ideas of reducing the size of the government and liberalizing the economy. And in just one day, he brought the government expenditure down from 39% of the GDP to 32% by reducing primary expenditure 30% in real terms in just 1 year. A fact that is really unprecedented in the contemporary history in emerging markets. Maybe some of the countries that exited the Soviet Union at the beginning of the 90s, but in the last 20 years, this is an unprecedented story. So the good news is that after that sharp adjustment in 24, the economy is expanding in 25. The sovereign spreads that were north of 2,000 basis points above U.S. Treasuries prior to Milei now are 700, still high but falling. Well, we are seeing an incipient process of FDI interested in Argentina, especially in mining and on our very rich non-conventional basin of oil, Vaca Muerta. So I'm really optimistic on that, and I think that there's a lot of value still hidden that potentially can attract investors. In terms of the next Argentina, in terms of value creation for investors, I see two event-driven stories coming next year in South America. One is Brazil. Brazil has elections in October. President Lula in this third term was not the same as Lula in his first term in office when he was very austere in fiscal terms. And now he's running a -1 fiscal deficit that is driving up debt to GDP. So if an administration from the center to the center-right comes in October, which is highly likely, potentially that can unlock a lot of value, especially on the equity side that is really beaten down. And on the domestic currency bonds, which are also very cheap with rates trading at 15% annual. And the other case, and then I will stop so as not to consume more time, is Colombia. Colombia right now is run by President Petro. Colombia is an oil country with the president that is against the production of oil, something very, very strange. And it's very likely that the party of President Petro will lose elections in May next year, and a candidate from the center will take office and eventually unlocking a lot of value in Colombia. Colombia is a country rated BB+, with debt to GDP close to 50% of the GDP, very low, and is trading north of 500 basis points of spread against U.S. Treasuries. So again, that can compress 200 basis points, reducing the cost of capital, making the country again attractive for investment. So we are looking also to Colombia. So in the region, I think that these two opportunities are the ones that the investors should focus on.
Yeah, we don't spend enough time talking about that, but hopefully in the future we will. So I'm going to go to Andrew, who looks at the world through sort of the LP lens, and let's talk about that, because we spend a lot of time on our show talking about tariffs for obvious reasons, but what are the implications, in your opinion? You can sort of amplify your answer in terms of the impact it's had on portfolios in the LP world.
Yeah, so thank you for that. So yeah, my day job is really working with LPs, and so we're thinking about it both on the public alts and private alt side of things. The tariff volatility, we've experienced here to date is certainly something that has driven a lot of LPs to reevaluate their portfolio construction and has reminded folks that there is certainly no panacea. Diversification is kind of, basic as it is really the only route through this. We saw in April a failure of diversifiers to diversify in some cases. If you own trend followers, while I think everybody accepts that what happened in April made sense in the context of their performance, it's kind of cold comfort when the strategy you own is the source of the pain. And moreover, you also have the US dollar, the devaluation there, driving, I think, also concerns around a broader diversification within asset bases, exploration of things like gold, even digital assets, other currencies. We're certainly seeing a lot of LPs focus on those other areas. I'd also say that diversification across regions within DM has been absolutely about Europe. Your average North American allocator is materially underweight Europe relative to kind of where the benchmarks may or may not suggest they should be. And so exploring that, I think, is definitely something we're seeing a lot of. There's a lot of tire kicking. I'm not necessarily sure we're seeing all that much money transacting yet, but we'll see if that manifests in the data. And the other, on the EM side, I would say that India and to a lesser extent Latin America, and also certainly the EM macro folks, I think are certainly of interest as people think about the broader ramifications of the trade war.
Scott, I'm going to play a little stock market with you, and I understand it's not just a simple math problem, but I think at current levels, the S&P at 6,000, we're trading at approximately 22 times-ish next year's earnings, which is historically rich. So how do you sort of square that away in an economy that seems to be slowing? I mean, are we just in an environment where people are willing to pay a higher valuation for a dollar's worth of earnings? Like, how do you sort of come to grips with what is, I think, an expensive market?
Yeah, I think the starting point for this is you mentioned historic, Guy, and historic needs some context, right? So essentially what's happened through an S&P 500 lens is you had this changing nature of the index where, historic average is that the cyclical part of the index would contribute, 35, 40% of the earnings for the S&P. That's now down to like 20, 25%. On the flip side, the growth part of the market, this is where your Mag 7 and other related tech plays come into play. They're now contributing 40%-ish of the S&P 500 earnings trajectory. So what you get here is a changing composition with a stronger underlying growth component to it, which, by the way, is not coming at the expense of other factors, such as capital expenditure trends and share repurchase trends, such that we have this very unique setup right now through S&P 500, i.e. US large cap, where you've got a very important part of the market with a structural growth driver to it that differentiates it from the rest of the world. So when we look at this, Guy, we said, there are a lot of elements here. No question we're pushing higher valuations versus history. There's some explanation in terms of composition under the surface. Ultimately, though, what the market's starting to do is read through longer-term implications of AI and other related productivity tailwinds into higher terminal values. So when we step back and look at the globe, a little bit differentiated view on this is that I look at the U.S. as your growth vehicle, particularly large cap U.S., right? I look at the rest of the world, though, as much more of a classic cyclical, economic sensitive profile that has more of a value characteristic. So it's apples to oranges, right? So what we look for in this is those companies that we think have best underlying structural growth trajectories. As long as those are in place, I'm okay with the valuations.
Mm-hmm. Since you mentioned AI, Sean, I'm going to go to you. It was a few months ago, DeepSeek came out, it disrupted our market, but speak to what you believe the AI ecosystem is in China right now.
Yeah, so AI has always been a big focus at Tria Capital. Like the two sector we focus, TMT and consumer, AI is a big part. So I would say within the AI segment, this is how we sort of look at the whole ecosystem. There's three big part of the whole story. One is the AI brain. So anything like all the LLM model that creates the OpenAI, like DeepSeek, et cetera, et cetera. So if you compare this three region, like US versus in China, the first part is where China is sort of lagging behind because a lot of the GPU restrictions from NVIDIA, et cetera. So this part really needs to be going through by different software or integrated or better engineering like DeepSeek to go around it. But the second part, which is utilizing a lot of the different data to train your brain, we think this part within China potentially has a big advantage, right? So if you think about China, it has 1.4 billion population size. With most of the attitude towards data privacy is much more open and lenient to being collective, view a lot of these data more as an asset, whereas in US and European, they're more concerned on the privacy side. And also, if you look at the adoption rate with a lot of these to generate the different data, in China it's huge. Like we look at a few statistics, for example, for teenager, more than 30% of the people spend more than 6 hours on their phone, right? If you look at all the DAU people for like TikTok, people spend more than 2 hours on TikTok, the platform. So ineffectively, they're giving you a lot of their personal data or information where you can use these to train different part of AI. If you look at China, the e-commerce penetration rate is one of the highest. If you look at their food delivery, if you look at even the payment stuff, everything's done by WeChat Pay, Alipay. Even the EV car nowadays integrated within your app. So there will be more and more digitalization. And we understand this quite best because our fund name, Tria Capital, is triangulating data. So we actually have a data team within Shenzhen and compute all these data and try to collect and understand different companies. And then the third part where we think it's the ability to create a super app. So anything that the consumer actually uses to integrate all these different AI to day-to-day use and to add that consumer valuation, right? We think in China, if you look at US, again, a lot of these are more vertical. So Google is more for search, Meta is more for social, Apple is more for phone, so each have their own more specialties. But within China, a lot of them, for example, Tencent have the WeChat system is really the messaging go-to app. And then there has the social Pengyouquan, which is the social app within. If you look at payment, it's also within a WeChat ecosystem. So they have a few of these super app, I would say, that includes a lot round of the different aspect of the things. So once they rolled out something within the AI space, it's much easier for a lot of the consumer to adapt. So if you look at the stats that Tencent just rolled out Yuanbao, which is one of their AI app, within 2 weeks, it actually ramped up to 16 million of DAU, which is similar to when ByteDance rolled out their Doubao. It took them like 1 year to have that amount of DAU. Right, so this actually on the super app part is a lot of the focus at Tria Capital. We're trying to identify what are the potential companies that can potentially win out within these ecosystem. So we're actually looking at a lot of the different AI talent hiring process, et cetera, to see who potentially could win out within this space. If you look at China, the amount of AI researchers, like STEM graduate, anything from scientific, engineering, mathematics, it has around 3.6 million graduate last year. That's similarly to US plus India plus several European countries, right? So they have a lot of potential there. If you look at the potential on the AI adoption, we're a big believer of there's more and more different adoptions. So we're doing a lot of research on the potential super app.
Nicolas, geopolitical risk has far-reaching ramifications. I mentioned World Bank, IMF. I mean, your background is extraordinary. When I started my career, if the US dollar was to move 1% or 2% over the course of a month, it was a big deal. Now it happens over the course of a couple hours. And it seems as though the geopolitical risk has had people, or the inclination is to sort of flee from the US dollar. So how important are these currency moves in your world? Because you're talking about a continent whose currencies move, but in terms of the Argentina and peso, I mean, it moves every day in meaningful ways. How does that impact your investing decisions?
Well, very, very interesting issue because, one salient issue of what we are seeing this year with all the volatility coming from, tariff implementation, but the new US administration, is that coupled with this volatility and the depreciation of the US dollar, contrary to what we saw in the past, emerging market economies appreciated, so their currencies to appreciate. In the same manner as the euro did, the Swedish krona, or the Great Britain pound, or the Japanese yen. In the past, with much weaker fundamentals and less institutionalized floating exchange rate regimes and weaker finances. Once you saw the dollar enter into a period of volatility, typically EMFX sold off together with the dollar. And now EMFX is like, in another step as a more mature asset, behaving more similar to other major currencies that are more established. And if you take a look at the behavior of the most important traditional asset classes since the behavior of in terms of return of the traditional asset classes since the beginning of the year, what you will find is that the best performing asset class is the local currency bonds issued by emerging markets, the ones as measured by the GBI index of JP Morgan. Well, that is delivering north of 10% since the beginning of the year. And that's something new. In the past, together with volatility in the US, those have posted negative returns. So there's a combination. First, the improvement in fundamentals in EM, coupled with the fact that a lot of EM countries are fighting inflation. Inflation rate still coming from the aftermath of COVID is above their inflation targets. Let's take the case of Mexico, Brazil, South Africa. Still, the inflation rate is slightly higher than the inflation target of the central bank, like in the US, which is north of 2%. So yields in EM are still high. For example, in Brazil, the policy rate is at 14.5, in Mexico 8.5, in Colombia is also north of 8. So that creates very interesting real yields to potentially attract capital. And in this case, with more mature frameworks, this is occurring. So this is new.
Andrew, when the Fed, I know everybody knows this, when the Fed cut rates in September, 10-year yields were about 3.6%. We then watched them go up 100 basis points, and as we're sitting here today, they're either side of 4.5, 4.45. The impact on higher rates in your world.
Yeah, I mean, there's so many different impacts. I think first and foremost, from an LP perspective, you're watching benchmarks, cash plus strategic benchmarks. You're watching the financing cost for your portable alpha program all increase pretty substantially. This has been the case, obviously, for a couple of years, but I would say that the first item that I would emphasize is we've definitely seen a lot more pressure on managers to add hurdles to their performance fees. And this is something that is, pretty unpopular with a lot of GPs out there, but we've actually seen material progress. Just put out another paper on this, and it's a huge piece of, what you're ultimately bleeding away if you choose to do nothing. One could argue it's the purest form of alpha. So I think that's one piece of it. And the other, I really think, is capital efficiency, which I know, some other folks have been talking about. I think, candidly, a lot of LPs have talked a big game when it comes to capital efficiency, trying to amplify and move up the risk-return curve. I think the reality is that governance just generally creates an impediment to being able to move up to, the kind of punchier assets that you need in order to more reliably hit your benchmarks. And so, said differently, your average investment staff member may be sitting there looking at a 20 vol strategy saying that's the right option. But the reality is they also know that their career may not survive the drawdown that ensues if their governance, may be kind of picky on that. And even more to the point, educating your governance today is not necessarily going to sufficiently insulate you against your governance in 3 years or 5 years. These things turn over. Ensuring you have the right people that are aligned in the right way is critically important.
Sean, we spent a lot of time talking about the companies in the United States that might be vulnerable in terms of U.S. China relations. Within China, speak to the companies that are vulnerable, but some that are sort of maybe set up to do really well in this type of environment, if you can.
Yeah, so for us, in terms of tariff or et cetera, we don't think there's a way to predict. But if you look from a bottom-up perspective, the different sector that we're focusing on, first is AI, where we talk about. So I'll say within our portfolio, 1/3 is directly on AI, 1/3 is AI related, and 1/3 is probably nothing to do with AI. But within this whole AI theme and quick changing theme, we think there is a lot of opportunity, both from the software to the adoption to how do you store the AI, the infrastructure, et cetera. There's tremendous amount of opportunity there, especially when you have that amount of data size, the amount of population. So we think that could be one of the very compelling, interesting places to look for investment. Second is on the consumer side, right? So on one hand, we talk about tariff, it's really more export driven, but even domestic business within China is huge, right? You can see recently there's a lot of milk tea company been listed in Hong Kong, even one in U.S., right? So even just because of the sheer size of the economy, there's a lot more domestic consumption story from tier 1 city to lower tier cities where we do a lot of different research. And the question is, a lot of these companies, which one are the ones that we will create a very strong competitive edge, but it's also sustainable, right? Because a lot of these companies, quite easy to be quite hot on the day, et cetera, but how is this competitive edge transferred to a very sustainable business for the next 5-10 years to come, and eventually leverage these to oversee market, right? So we're starting to look at a lot of the brand names that are able to do well overseas as well, right? So you can see, for example, Luckin Coffee starting to expand overseas. They have 3x the stores of Starbucks in China, right? So we're starting to study some of these companies that we think, hey, not only first they leverage the domestic market, then eventually they go overseas. And some of them within the U.S. market, because tariff, because geopolitical situation, might get hurt a little bit, but they might be able to do well in other regional market first to prove themselves, to build that out, and eventually to penetrate elsewhere. So these are also some of the companies that we look at a lot. And third is really anything that's very strongly innovative. So you can see like a bunch of like robotic. We still think it's in the very early stage and humanoid, et cetera. But a lot of these, especially we're sitting within Shenzhen, we're looking at a lot of different technology advance. We're looking at, for example, food delivery. Meituan starting to test out 25 sites within China in Shenzhen to do a drone delivery, right? So a lot of these new innovation, new technology, where it leads to better economic outlook, it's also where we spend a lot of time.
Scott, geopolitical risk, sometimes we create it ourselves. And in my opinion, we've created it in some ways at our debt levels, and specifically sort of debt to GDP. How do you sort of think about the importance of it in terms of what it means for the bond market, what it means for the equity market?
Yeah, first I would say in terms of geopolitical risks in general, whenever a circumstance unfolds, we tend to quickly go to, okay, what's the impact going to be on global macros? And does that provide a headwind or not to underlying fundamentals? We like to differentiate between what I would say is Wall Street and Main Street, where so much macro attention gets placed on Main Street, but what I would argue is that Main Street's much different than Wall Street via the S&P 500, okay? So I get it. What comes with very strong deficit levels, the fiscal positive impulse we've had certainly going back to the COVID days and coming out of that, is actually at some level an underlying tailwind for macro activity and fundamentals. So we got that. That's a positive. So when you hear, my gosh, we're not making a dent in the $2 trillion a year deficit, I get it. That's an issue. But it's probably, on one hand, a net positive for fundamentals. The issue is, to your point, Guy, that when you begin to look at the crowding out effect of U.S. Treasuries over time, and an underlying big concern here is monetary debasement. And we have to give that a lot of attention. So we watch the rate backdrop in the potential risk for term premium staying a little bit higher. Number one, does that choke off future growth initiatives? Number two, how do we factor that into a valuation component in terms of a bigger U.S. equity lens? So to your point, that's where I keep coming back to, I got to have offsets. Show me the growth, tell me that AI is still second or third inning, and it's going to end up permeating down away from just growth into broader company behavior, where you're seeing the opportunity for productivity improvement, margin improvement, and with that, better valuations, you get offsetting mechanisms here. So we're very aware, but under the surface, let's keep an eye on where those growth drivers are taking us.
We didn't have a lot of time, and I apologize, but Andrew, in the final sort of minute and a half we have, anything you want to sort of amplify that we didn't get a chance to sort of talk about?
Yeah, I mean, I would say, on the opportunity set perspective, I would say discretionary macro is probably something that I would just kind of amplify as an opportunity set, both within EM and in DM. If there is ever a time for discretionary macro managers to make their money, now is it. And so their ability to kind of exploit these, the kind of policy volatility that we've experienced should be paramount.
Nicolas, same to you.
Well, yes, very interesting environment. You know, key question for us is where we will find the long U.S. rates in the next few months. So real rates are high, so that provides some buffer. But that will be one of the keys in determining, you know, the returns for EM in the next few months. In our view, given that we expect the deceleration in U.S. and global growth, actual real rates that are very high provides a buffer, and you will see slightly lower long-term rates in the U.S. in the near future, and that will be a catalyst for further appreciation of EM assets.
Sean.
I'll say right now there's a lot of uncertainty in the world, but especially within the China market that we're focusing on, it's one of the best opportunity I see within my career in terms of, you know, on one hand, it's extremely cheap, very distressed valuation, but also there's a lot of innovation happening, a lot of great companies. So it's really buying a great asset at a distressed price. So for us, like Warren Buffett said, you know, be greedy when other people are fearful.
And Scott, I started with you, I'll end with you.
Yeah, so where I'm going with this is that if it hasn't come through yet, let me be clear. I'm a long-term structural bull on the S&P 500 from an index construction perspective, and the way performance drivers fundamentally are unfolding. But I completely also recognize that as we move further away from 23, 24, with that big, global growth focus, that you begin to shift the narrative to where the world becomes more of an equal playing field. So beyond this mega cap growth cohort, I think the opportunity for broadening geographically and up and down the cap spectrum, I think is going to define the next couple of years.
Round of applause for Andrew, Nicolas, Sean, and Scott. Thanks everybody for your time.